Stop scrolling. 9 days ago, something happened in the US bond market that should have been front page news on every financial outlet in the country. It wasn't. The US Treasury held an auction for $16 billion worth of 20-year bonds. And the buyers who were supposed to show up showed up with less enthusiasm than at any point this year. Yields came in at 5.122%, up from 4.810% the month before. That's a 31 basis point jump in a single auction cycle. And here's the part that should make you stop scrolling. This wasn't random. This wasn't a blip. This was the exact signal I told you to watch for 2 videos ago. If you've been following this channel for the last 2 weeks, you already know the setup. You know who's been quietly buying the $39 trillion debt. You know why Bitcoin-backed yield products are competing directly with your treasuries and bonds. Today I'm showing you what happens when those two forces collide, and what the May 20th auction tells us about what's coming next for your retirement account. Stay with me. This is the one that ties it all together. Let me start with what actually happened on May 20th, because the financial media buried the lead. The US Treasury Department needed to sell $16 billion worth of 20-year bonds. Routine auction, happens every month. But this one didn't go well. The bid to cover ratio, that's the measure of how many buyers show up for every dollar of debt on offer, came in at 2.55, below the 10 auction average of 2.58. And the yield the Treasury had to offer to get the bonds sold came in at 5.122%, nearly a third of a percentage point higher than the previous month's auction. In plain language, buyers demanded more to show up. And when long-term Treasury yields spike like that, here's what happens. Your bond ETFs lose value. Your 60-40 portfolio takes a hit. And pension funds and retirement accounts holding long-duration treasuries see their paper value drop, even if nobody tells them. And this didn't happen in a vacuum. Congress is currently wrestling with a tax and spending bill that the market believes will make the fiscal outlook significantly worse, not better. Long-term investors were voting with their wallets. They want more compensation to hold US debt. And on May 20th, the Treasury had to give it to them. Now. If this were a one-time event, I'd tell you not to worry about it. Weak auctions happen. But this isn't isolated, and that's what changes everything. To understand why this auction matters, you need to understand 2 things. First, how Treasury auctions actually work. Second, why this one was the canary I warned you about. Here's how it works. When the US government needs to borrow money, the Treasury holds an auction. Primary dealers, the big banks like JP Morgan, Goldman, Citi, are required to participate. They bid on the debt, then resell it to their clients, pension funds, foreign governments, insurance companies, sovereign wealth funds. The health of an auction tells you something critical. Are the people who are supposed to buy this debt actually showing up? Or are they quietly stepping back? On May 20th, they stepped back, just enough to matter. And this wasn't the first time in 2026 that this pattern showed up. Back in March, auctions for 2-year, 5-year, and 7-year notes all cleared at higher than expected yields. All 3 required greater participation from primary dealers just to absorb the issuance. What does that mean in plain language? It means the big banks are increasingly becoming the buyer of last resort for US government debt. The natural buyers, foreign governments, pension funds, long-term institutional investors, are becoming less enthusiastic. Now add one more layer. The nation's fiscal outlook is deteriorating in real time. The deficit is running above $2 trillion. Spending is rising, tax revenue is uncertain, and the market's response is simple and brutal. If you want me to lend you money for 20 years, you need to pay me more. That is what a 31 basis point jump in a single auction cycle tells you. And here's where this gets personal. If you have money in a 60-40 portfolio, that's 60% stocks, 40% bonds, the bond portion is supposed to be the safe part, the part that cushions your portfolio when stocks drop. But when Treasury yields spike like they did on May 20th, bond prices fall. Both sides of your portfolio take a hit simultaneously. The protection you thought you had isn't protecting you anymore. If you want to drop a comment on this video, are you currently holding bond ETFs like TLT or BND? Because the next video I'm doing is going to be specifically about what happens to those funds when institutional money walks away from long-duration treasuries. I'll be reading every comment. Now here's where this connects to everything we've been talking about for the last 2 weeks. In video 1, I showed you that the $39 trillion US debt load has a hidden buyer, and it isn't who you think. In video 2, I showed you that Bitcoin-backed yield products, paying 11% and higher, are now competing directly with treasuries for institutional money. Today, the third piece just clicked into place. Weak treasury auctions aren't just a fiscal policy problem. They're a rotation signal. When institutional money starts demanding higher and higher yields just to show up at treasury auctions, that capital is telling you something. It's saying the risk-reward on holding long-duration US debt is no longer automatic. It's no longer the safe default. And when that happens, that capital has to go somewhere. Some of it goes into shorter duration treasuries. Some goes into corporate bonds. Some goes into gold. And increasingly, the data says, some of it is going into Bitcoin. Here's why this matters mechanically. When 20-year treasury yields hit 5.122%, that sounds attractive. But remember what I told you in the last video. The real yield, adjusted for actual inflation, is much lower. And the duration risk on a 20-year bond is enormous. If yields rise another 1%, the price of that bond drops roughly 15%. Bitcoin-backed yield products don't carry the same long-duration bond math. They carry a different risk stack: volatility, custody, liquidity, platform risk. These are real risks, and I'm not dismissing them. But here's the point. Institutional capital is now comparing treasury risk against a growing menu of alternatives. And that comparison wasn't even on the table 5 years ago. The May 20th auction tells you that menu is getting more crowded. I'm not telling you to go sell your bonds and buy Bitcoin. That is not financial advice, and that's not what this channel does. What I am telling you is this. The institutional money managers who run the pension funds and sovereign wealth funds, the ones who are supposed to show up at treasury auctions, they're doing the math. And the math is getting harder to ignore. Here's the bottom line. The May 20th treasury auction wasn't a disaster. But it wasn't nothing either. It was the latest data point in a trend this channel has been tracking for 2 weeks. That the $39 trillion debt load is straining the system that's supposed to absorb it. That the buyers who are supposed to show up are showing up with less conviction. And that the capital looking for yield and protection is quietly finding new homes. You now have the full arc. Who's buying the debt? What's replacing treasuries in institutional portfolios? And what happens when the buyers start demanding more to stay in the room? If you want the deeper breakdown, the full auction data, the corporate Bitcoin treasury tracker, and my personal watch list for the next 90 days, I've linked it in the description below at timtalksfinance.com. It's free. Next week, I'm digging into what this means specifically for bond ETFs, TLT, BND, the aggregate bond funds sitting in millions of retirement accounts. When institutional money walks away from long-duration treasuries, those funds have to rebalance. And the mechanics of how they do it are something most investors have never thought about. That video is going to surprise you. Subscribe so you don't miss it. I'll see you